most investors are asking the wrong question right now. They keep asking, what should I buy next? But smart money is asking a very different question. Where should I hide, protect, and quietly position my capital in 2026? And that shift in thinking is the most important investment lesson of this decade. It's opposed because while most people are still arguing about which stock will bounce, the smart money has already moved. In this video, I will show you exactly where capital is quietly flowing in 2026, why it is leaving traditional investments, and at the end, I will reveal the one mindset shift smart money made that most Filipino investors still have not realized. Stay until the end because this changes how you invest forever. Let us start with an uncomfortable truth. The Philippine stock market has gone almost nowhere for more than a decade. If you invested consistently and did everything right, you likely did not lose money, but you also did not build meaningful wealth. Compare that to the United States, where major indices multiplied several times over the same period. While American investors benefited from innovation, scale, and global capital flows, Filipino investors faced slow growth, thin liquidity, and a market that punished patience. This is not about blaming anyone. It is about recognizing reality. The economy today feels uncertain, and that uncertainty is not imagined. High food prices, rising daily expenses, currency weakness, and slower growth are changing how money behaves. When conditions are strong, capital chases growth. When conditions are weak or unclear, capital looks for safety, predictability, and flexibility. This is exactly what is happening now. Smart money is not louder. It is quieter. It is not chasing headlines. It is quietly repositioning. The first place smart money is moving toward in 2026 is predictable cash flows. This includes government-backed savings programs like MP2, high-interest digital banks, and instruments that pay consistently rather than promise future growth. In an environment where visibility is poor, the value of knowing what you will earn matters more than hoping for upside. This is why MP2 continues to attract long-term capital, not because it is exciting, but because it is boring, stable, and backed by the government. When people with large capital choose boring, it tells you something. The second area smart money favors is cash with yield. Digital banks offering higher interest rates are not about getting rich. They are about staying liquid while being paid to wait. Cash today is no longer dead. Cash is optionality. It allows you to move when opportunities appear without being forced to sell assets at the wrong time. This is a critical shift. In the past, staying in cash felt like missing out. Today, staying liquid feels like control. Next, smart money is still in equities, but with a very different mindset. It is no longer chasing aggressive growth stocks or exciting stories. It is focusing on dividend-paying businesses with real cash flow. These are companies that can pay you even if prices go nowhere. This includes select utilities, infrastructure plays, and defensive names that benefit from necessity rather than optimism. The goal is not price appreciation first. The goal is income and survivability. REITs also play a role, but only the right kind. Smart money is not buying property exposure blindly. It is avoiding highly leveraged developers and focusing on REITs with strong tenants, stable occupancy, and realistic valuations. This is an important distinction. Real estate itself may be under pressure, but income-producing assets with long-term contracts still have value. Smart money separates property speculation from property cash flow. Another quiet but powerful move is geographical diversification. Smart money is reducing single country risk. This does not mean abandoning the Philippines. It means not keeping everything in pesos or in one market. Exposure to US dollar assets, global funds, or even holding part of wealth in stronger currencies is a form of risk management. When your currency weakens, your purchasing power erodes silently. Smart money pays attention to this. Now let us talk about what smart money is avoiding. It is avoiding highly leveraged businesses that depend on cheap debt. It is avoiding founder-driven hype companies where valuation depends more on personality than performance. It is avoiding story stocks that promise the future but cannot produce cash today. It is also avoiding over-concentration in any single asset, sector, or idea. Concentration makes you rich in good times and poor in bad times. Smart money chooses survival first. This is where many Filipino investors feel uncomfortable because this approach feels slow. It feels conservative. It feels like giving up on big wins. But here is the reality. You do not need big wins if you avoid big losses. Most wealth is not built by hitting home runs. It is built by staying in the game long enough for compounding to work. Let me paint a picture and imagine two investors. One kept chasing the next big thing in a weak market. The other focused on capital protection, steady income, and flexibility. 10 years later, the second investor did not make exciting headlines but quietly built stronger balance sheet, better cash flow, and more options. That is how real wealth looks. It is boring from the outside and powerful from the inside. Here is the key realization most people miss. Smart money does not try to predict the future. It prepares for multiple outcomes. It builds portfolios that survive inflation, currency weakness, market stagnation, and unexpected shocks. That is why it favors income, liquidity, and diversification in times like these. Now, let me reveal the most important insight I promised at the beginning. Smart money stopped asking how much can I make and started asking how much can I protect. That single shift changes everything. When you protect capital, growth eventually follows. When you chase growth without protection, capital disappears. This does not mean you made a mistake investing in the Philippines. It means the environment changed and strategies must evolve. The investors who win in 2026 are not the bravest. They are the most adaptable. They understand that cycles change, markets rotate, and survival is the foundation of success. If you think like smart money, you stop reacting to noise. You stop comparing yourself to others. You build a portfolio designed for uncertainty, not perfection. And when conditions improve, you are still standing with capital ready to move. That is how smart money plays the game in 2026.